Welcome back to Synaptic Dividends. We break down a new dividend stock every single week to help you build your passive income portfolio. If that's your goal, make sure you're subscribed so you don't miss out. Now, today we're looking at the home improvement giant Lowe's, and we're asking a pretty simple question. Is its dividend built on a solid foundation, or are there some cracks starting to show?
So is it built to last? You know how we do it here. We're not going to listen to opinions or scary headlines. We're going to do one thing and one thing only. Dive straight into the hard numbers. The numbers don't lie. So let's see what the data actually tells us.
All right, first things first. Whenever you look at a dividend stock, you have to ask the most important question right up front. Is the dividend actually safe? And to figure that out, we look at one key metric. It's called the payout ratio.
Now, specifically, we're looking at the free cash flow payout ratio. And don't let the name scare you, it's actually super simple. Think about your own budget. After you pay your mortgage, your car payment, your groceries, all the essential stuff, the cash you have left over, that's your free cash flow. This ratio just tells us what percentage of that cash the company is using to pay us, the shareholders, our dividend. And with this number, lower is always better.
And when we look at the trend for Lowe's over the past 5 years, it tells a really interesting story. You can see back in 2020, they were barely using 18% of their cash to pay the dividend. Now, yeah, that number has climbed, but here's the key thing to understand. Every single one of these numbers is incredibly healthy. As a rule of thumb, anything under 60% is considered really safe. And that brings us to the most recent number, 46.5%. So what does this actually mean? Well, to put it simply, for every $1 that Lowe's pays out in dividends, it's actually generating more than $2 in cold, hard cash. They have this massive cushion, this huge margin of safety, which tells us the dividend is exceptionally well covered. Okay, so safety? Check. But a great dividend doesn't just survive, it has to grow. Let's check out the history.
Look, a safe dividend is fantastic. It's the bare minimum, right? But what we really want to see is a dividend that's growing over time, giving us a pay raise every single year. So has Lowe's been consistently rewarding its shareholders? Well, the history here is, honestly, it's pretty remarkable.
Get a load of this. 54 straight years of increasing their dividend. Nope, that's not a typo. That performance puts Lowe's into a very exclusive club of companies called Dividend Kings. We're talking about companies that have raised their dividend for over half a century. That kind of track record is just incredibly rare, and it screams that this is a durable, high-quality business.
But here's the thing. They haven't just been raising it, they've been raising it at a blistering pace. Just look at that 10-year average growth rate, almost 19% a year. You know what that means? At that rate, the dividend income you get from this stock literally doubles about every 4 years. That is the incredible power of compounding right there on your screen.
Now, I know what you're thinking. You're looking at that last number, the one-year growth of 4.7%, and you're thinking, whoa, what's with the slowdown? But here's why that's not a red flag. This is actually a sign of smart, mature management. They're shifting from those crazy growth rates to a more sustainable pace to make sure they can keep that 54-year streak going for another 54 years.
So let's recap. The dividend is safe. It's got a world-class growth history. But here comes the final boss. This is the ultimate test. How does this dividend hold up when the economy completely falls apart? Let's put it through a stress test.
This is just incredible. Let's go back to 2008, the absolute heart of the global financial crisis. The housing market is collapsing. And what does a home improvement company like Lowe's do? They didn't just maintain the dividend, they didn't just squeak by, they gave their shareholders a massive 27% raise. It just goes to show you, even when the world is ending, roofs still leak and toilets still break. Their business is essential.
And just in case you thought that was a fluke, they proved it all over again during the next major crisis. Fast forward to 2021, peak pandemic uncertainty. What did they do? They hit the accelerator again, handing out a nearly 25% dividend hike. This just proves, beyond a shadow of a doubt, that this dividend isn't just for the good times. It's a top priority for management through thick and thin.
Okay, we've looked at safety, we've looked at growth, and we've looked at resilience in a crisis. So when we strip away all the emotion, all the noise, and just look at the pure data, what is the final verdict on the Lowe's dividend? The report card is pretty darn clear. For safety, it gets an A+. That payout ratio leaves a huge margin for error. For growth, I mean, come on, being a dividend king with a 54-year streak says it all. And for resilience, it's basically crisis-proof, having passed 2 of the worst economic tests of our lifetime with flying colors.
So the numbers tell a very simple and very powerful story. Lowe's is, without a doubt, a premier dividend stock. It's got the safety, it's got the elite growth, and it has proven its durability when it matters most. If you want to go deeper and understand the full business model behind these numbers, check out our long-form podcast analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated, and subscribe for more dividend analyses. Thanks for watching.